So imagine a really big cookie jar. Everyone wants one, but there's a catch. The cookie monster decides how easy it is for you to get one. A weird analogy, but stick with me. This will all make sense in just a second. Whether you're new to Forex or you've been trading since dial-up internet, you have to talk about interest rates. Like you can't ignore them. They are everything in Forex trading. Today, I'm going to break them down so even your 5-year-old self would understand. And then on top of that, I'm going to make it actionable. Okay, think of interest rates as the cost of borrowing money or the reward for saving it. If interest rates are high, then it costs more to borrow. If interest rates are low, it's like a buy one get one free deal. Interest is how the loaner makes money. One of the most common use cases are mortgages, home loans. If we use the home loan, for example, you go to a bank and you want $500,000. They'll give you this $500,000 over 30 years for you to pay it back. Now, if you just paid back that $500,000, they won't make any money. Interest is what they charge for the loan. So you may pay an extra 5% per year on that loan amount. That is where they make their profits. Now, the beauty in interest rates is they mess with economies' money situations and decisions. If you go to a vending machine and you see a can of Coke is $10, there's a good chance you're going to say no thank you. But if you go in and you see that it's just $1, you might even buy 3. This works in the economy on a much bigger scale. So we've got these big financial wizards called central banks, and their job is to essentially control money flow within economies. Before we go all tinfoil hat, yes, they control money flow. No, we're not going to dive into a conspiracy theory. It's just a central bank. So these wizards, if they deem the economy to be a little bit too hyped, they'll raise interest rates and spending will cool off. It's like putting the economy in timeout because it's been performing a little bit too aggressively. But if the economy is looking sad, like the loaner, they lower rates, encouraging spending. It's like yelling shots on me at a bar to get the party going again. Here's where it gets juicy, and Forex pros, you know the deal. Interest rates drive currency strength. If interest rates are prone to go higher, it is likely the currency will gain strength. Why? Because the loaners or investors want that sweet, sweet higher interest rate for that juicy money return. If the US raises interest rates and Europe keep them low, it's a no-brainer. The dollar is just going to flex on the euro. It's like choosing between a savings account that gives you 10% interest or one that gives you 1%. Now, I'm hoping you're a good enough trader to recognize which one's going to be more beneficial. And when you go a little bit deeper, you uncover something called carry trades. That's when really smart investors borrow money from those lower interest rate currencies and just use that money to invest in the higher interest rate currencies. Genius. But that's a story for another day. We can dive into carry trades in another video. For now, let's get back into Forex. So what happens when the cookie monster suddenly changes the rules of the cookie jar? If rates go up, borrowing slows, spending stops, and currencies get stronger. The opposite, if interest rates drop, spending increases and currencies may get weaker. Think of it like buying tickets to a concert. If you see prices have doubled, you're staying home. But if you see that they're up for sale for $5, you're losing money by not attending that. So as Forex traders, why do we care? Well, they're like the GPS. They actually guide currency strength and weakness, and they can give you massive insights into where long-term and large amounts of money is going to flow. Now, as traders, we analyze the central bank decisions, but we also look into things like inflation data, GDP, unemployment rates, because they can give us insights into what the cookie monster is actually thinking. How many cookies are in the jar, and what's the demand for the cookie? As traders, we bet on probabilities. We don't wait for the central bank to make a decision and then put our money there. We're already thinking 2, 3, 4 months in advance. By the time you've figured out the central bank is going to raise rates, it's probably too late. The move's gone. So we look elsewhere. We try and figure out where the risks of increase or dropping rates are, and we place our money then. By the time the rate is being dropped, we've already made our money and we're on our way. If you're interested in learning a little bit more about how to predict interest rates or even use the futures markets to just blatantly show you where the market is predicting, leave a comment below and we'll start chatting. All right, I'm getting carried away into the nitty gritty. Let's take it back up and let's give you the TLDR. Interest rates, the cost of borrowing or the reward of saving. Central banks are the cookie monster. They control it to keep it balanced. In Forex, higher rates means a stronger currency, lower rates means a weaker currency. Not always, there's nuances, but there's a general rule of thumb. As traders, we live for those rate changes because that's where money can be made. A lot of traders think these fundamentals are too complicated, too complex, but trust me, it's not magic, it's just how these economies actually work. And if you understand how the asset actually works, you know how to position yourself. You can make your job a lot easier. There you go, there's interest rates. Now, go trade smart. We'll catch you in the next video.